a company trading at a 75% discount to its peers, despite being the number one market leader with better profitability. That's NICE. Ticker NICE. They power the AI behind customer service for 85% of Fortune 100 companies. When you call your bank or airline, NICE's technology is likely running that interaction. I'm rating this stock a strong buy with a $185 price target, which represents 74% upside. And just to show you I'm putting my money where my mouth is, NICE currently represents 6% of my personal portfolio. Let me show you why the market is wrong on this one. The market is overlooking NICE's durable advantages. They're the number one player with 22% share in a $105 billion market, growing at 18% annually. They're deeply embedded in 85% of Fortune 100 companies with switching costs that keep customers locked in. Their profitability is exceptional. 28.3% EBITDA margins, more than 6 percentage points better than competitors, with 92% cash conversion, generating $700 million in free cash annually. Yet they trade at 12 times earnings, while peers trade at 48 times. This valuation gap creates the opportunity. This chart shows the disconnect. NICE at 12 times forward PE, peers at 48 times. Looking at enterprise value multiples, NICE is at 8 times versus 30 times for peers. Despite having 28.3% EBITDA margins versus 22% peer average, and being number one in market position, NICE trades at roughly a 75% discount. The question is why and what catalyst will close this gap? NICE commands 22% of contact center as a service market, ahead of Genesys at 18%, Amazon Connect at 15%, and Five9 at 12%. This isn't a winner-take-all market, but leadership matters. The total market is $105 billion in 2024, growing at 18% through 2032. That's a massive runway. The proof of defensibility? 11 consecutive years as Gartner's Magic Quadrant leader, and they're embedded in 85% of Fortune 100 companies. That penetration is extraordinary. Enterprise deployments involve $5 to $10 million in integration costs, agent retraining, and workflow re-engineering. The result? Over 95% gross retention. Once you're in, you stay. Their Enlighten AI engine is trained on 30 billion customer interactions annually. More data makes the AI smarter, creating a cycle competitors can't easily replicate. Being Gartner's number one for 11 years means enterprise buyers default to NICE. And with $2.7 billion in revenue funding, $380 million in R&D, they can outspend competitors like Five9 who only have $120 million for innovation. Cloud ARR has grown from $1.56 billion to $2 billion, 25% year-over-year growth. Cloud now represents 73% of total revenue, up from 50% in 2020. High-quality, recurring revenue. The profitability story is even better. 28.3% EBITDA margins versus 22% peer average. 25.2% FCF margins versus 20% peers. That 630 basis point EBITDA premium demonstrates real operating leverage. EBITDA margins have expanded from 24.1% in 2020 to 28.3% today. That's 420 basis points of improvement in just 4 years. Management targets 30 to 32% by 2027. This happens because their cloud platform has inherent operating leverage. Incremental margins exceed 40%, meaning each additional dollar of revenue is highly profitable. Their CX1 Empower AI platform has a 97% attach rate in large enterprise deals over $1 million, ARR. That's not sales fluff, that's customer demand. Customers report 30 to 40% reduction in call handle time and 25% improvement in first call resolution. Real ROI. The $955 million Cognigy acquisition adds conversational AI capabilities, strengthening their generative AI position. This is strategic, not just buying revenue. The market has two primary fears driving this discount. First is the hyperscaler threat. Can NICE defend against Amazon, Salesforce, and ServiceNow, who can bundle services and compete on price? Second is leverage. Did the $955 million Cognigy acquisition over-leverage the balance sheet? Both risks are real, but they're more than priced in at this valuation. NICE focuses on complex Fortune 500 deployments with enterprise-grade features like workforce management and financial crime prevention. Switching costs are $5 to $10 million per deployment. Amazon Connect targets small and medium businesses and mid-market with basic call routing at 30 to 50% lower prices. Low switching costs. NICE's Moat is in the complex enterprise segment where 85% of Fortune 100 reside and won't compromise on capability. Amazon is winning elsewhere. Current net debt is $935 million, giving a debt-to-equity ratio of 2.25 times. Elevated, yes, but they generate over $700 million in annual free cash flow with 92% cash conversion. Using $400 to $500 million annually for debt paydown gets them to less than 1.5 times within 24 months. Interest coverage of 12.5 times provides cushion. This overhang is temporary and manageable. 3 valuation methods all point to significant upside. Comparable companies analysis gives $187 to $288. DCF gives $185 to $246. Scenario analysis gives $191. My $185 target sits at the conservative end. This isn't hoping for best case, it's a prudent estimate based on multiple approaches. Salesforce trades at 52 times PE with 22% margins. ServiceNow at 85 times with 24% margins. Five9 at 35 times with only 16% margins. NICE trades at 12.1 times PE with 28.3% margins. That's a 72% PE discount and 830 basis points better profitability. The gap isn't justified by fundamentals. NICE's profitability is substantially higher, yet it trades at a fraction of peer multiples. From 12.1 times P/E today to 20 times requires 4 catalysts. Successful Cognigy integration, deleveraging to less than 1.5 times. Sustained AI traction with that 97% attach rate. Margin expansion toward 30%. A 20 times PE on 2026 EPS of $9.25 gives $185, still a discount to the 48 times peer median. This requires execution, not heroics. Bear case has 20% probability, $125 price target, 20% downside. Base case has 50% probability, $185 target, 74% upside. Bull case has 30% probability, $245 target, 130% upside. That's a 3.7 to 1 reward to risk ratio. In the base case, I make 74%. In the bear case, I lose 20%. Those odds work. Overall business quality scores 82 out of 100. The competitive moat is wide but narrowing due to hyperscalers, yet remains formidable in enterprise. Revenue quality is high with 73% recurring and 110% net revenue retention. Management has executed the cloud transition successfully. Capital efficiency is strong with ROIC of 14.7 to 17.1% versus 9.8% cost of capital. Competitive commoditization is the highest risk at 75% probability and high severity. Financial leverage is medium risk at 40% probability but stable. M&A integration and technology disruption are medium risks to monitor. Economic recession risk is increasing at 35% probability. Overall, NICE presents a medium-high risk profile, but these risks are balanced by strong moats and a clear deleveraging path, making the risk-reward attractive at 12.1 times PE. You're buying a dominant market leader with best-in-class financials at a valuation that implies it's a struggling laggard. Leadership is protected by deep enterprise entrenchment, $5 to $10 million switching costs, and superior AI. Re-rating will be driven by AI platform growth, deleveraging via strong free cash flow and margin expansion. The market has overly punished the stock for manageable risks. NICE currently represents 6% of my portfolio. I'm invested in tracking metrics quarterly. Cloud ARR growth needs to stay above 20%. EBITDA margin needs progression toward 30% plus. Debt to equity ratio needs quarterly reduction toward less than 1.5 times by 2026. CX1 Empower attach rates need to maintain above 95%. These four metrics tell me if the thesis is on track. And one more thing before you go. If you want to follow along with all my trades in real time, I share everything on X at @ATIS_TAMALFA_trades. Every position I open, every position I close, full transparency. And if you want access to the full detailed versions of these investment reports, completely free, head over to tomalphatrades.com. That's where you'll find 50-plus page deep dives like the one we just covered today, all available for free to the community. All right, thanks again for watching, and I'll see you in the next one.